have about 15 minutes left before the pre-opening rates kick in. For now, let's discuss the big story of yesterday. CNBC TV 18 reported that a resolution plan is likely to be finalized for Jet Airways as early as this week. We also learned from sources that Naresh Goyal is likely to step down from the board and give up majority control in the ailing airline. Dheeraj Mathur, the executive director of PwC, joins us on the phone line. Dheeraj, good morning. Seems like this deal is getting closer to fruition. What are your own thoughts?
Yeah, good morning. Definitely Etihad has to put in the extra equity. Now, whether they should buy out, if they buy out Naresh Goyal, then of course the company doesn't get it. Naresh Goyal gets the money, but it's a company that needs the money, so maybe they should look at the appropriate mechanism for picking up the initial equity. Secondly, as far as Naresh Goyal losing control is concerned, I mean, I'm not really sure how useful that will be, because it isn't as if it's an issue with Naresh Goyal and some decisions that he took. I mean, the airlines made an acquisition of Deccan many years back. That, you can say, was probably a bad decision, but there were reasons for that decision. And essentially, the situation that it's in today is largely on that account. Otherwise, it has fared no worse than any of the other airlines in the last 1 year.
Dheeraj, the point is banks will restructure only if fresh equity comes. So it can't be a case that Etihad brings the money only to buy out Naresh Goyal's stake.
Absolutely.
They have to put new money. Do you think, in your knowledge of Etihad, they have that kind of money and willingness to put in fresh equity into the company?
It's a difficult question to answer because, I mean, they obviously do. They're also going through a bit of a rough patch, but it's a state-funded and state-owned airlines. I don't think cash is an issue with them. Okay. I guess the issues will really be more commercial and strategic rather than financial.
Okay, Dheeraj, thank you for giving us your thoughts. Thanks for joining us. That's the word coming in from PwC. Let's see which way it heads. Jet was the big gainer that we saw in trade yesterday, up about 16%. But let's get some F&O cues out of the way. Chandan Taparia of Motilal Oswal Securities joins in. Chandan, hi, good morning. What would the stock-specific calls be for the day?
Yeah, very good morning. Talking about the market, Nifty got stuck in a range, but volatility has spiked, so limited upside with downside could be there, so almost expecting choppy or range bound movement in the market. Talking about the stock specific, we have seen buying interest in selective pharma and FMCG pick in last couple of trading sessions, even after some profit booking in the broader market. So there is a reason that selected stocks from these sector. First trade is buy on Dabur. The stock has given a consolidation breakout on last trading session, and it is also respecting to its 50-day exponential moving average and surpassed the immediate hurdle of 428, 430 zone. So entire data setup suggests further up move, recommending to buy with stop loss of 423 for an upside target towards 450 to 453 kind of level. Second trade, that is from the pharma pack, is buy on Divi slip. The stock is holding well. Every small decline is being bought. We have seen a consolidation breakout and the stock is extended its support zone. We have seen buying interest in last 3-4 trading session, and longs are also added in the counter. So because of that, the up move could be seen towards 1590. One can buy with a stop loss of 1500. One trade that is on the negative side in the metal space, we have seen the formation of the lower top, lower bottom, and sustained call writing is visible in most of the metal stocks. So expecting weakness in the JSW Steel. The stock has failed to recover, and every small bounce is being sold, which is opening its downside towards 278, 275 zone. So one can buy 280 put with a stop loss of 3 rupees, and this put can move towards 11 rupees. One option strategy that is on the Reliance Industry. The stock has been consolidating in a broader range, and recently it has taken support at its rising support trend line. Technically, it is forming a symmetrical pattern, and it is taken support at the lower band of this trading range. On the option front, we have seen Intech put writing at 1100 and the lower strike. So the entire setup suggests an up move towards 1130, 1140 zone. So one can either go long or can go with the bull call spread by buying one lot of 1100 call, selling one lot of 1140 call. So in the entire this strategy, one has to pay the premium of 15 points, and to keep the better risk reward ratio, one can put the stop loss of 8 rupees for target of 30 rupees for this spread. And overall, we are expecting Reliance to move towards 1130 to 1140 levels.
Okay, well, Chandan, thanks a lot for that. Those are some F&O cues coming in, but we have some earnings coming in from the lot. The biggest one is Zee Entertainment. KPIT Technologies will also be through today. But let's find out what to expect from Zee with its Q3 numbers. Mangalam is here to run us through the expectations. Hi, Mangalam. Morning.
Morning, Sonia. So, for Zee, more than the numbers, the street will be watching out for a lot of news flow that took place in the quarter that went by, which also resulted in the underperformance of the stock. So, here is a spate of news flow that took place. The first one, of course, was multiple brokerages downgrading the stock for various reasons. The biggest one of them being the worries of increased investment towards Z5, and then the big news, the promoters' intention to sell 50% of their stake or get in a global partner for their business was something that caught people's attention or was on people's minds. As far as the numbers are concerned, we're expecting a revenue growth of 15% year-on-year in this quarter. The EBITDA is likely to grow higher than the revenue growth, leading to some sort of margin expansion, but that would be limited given the sort of investments that the company would be doing in Z5. So EBITDA growth of 20% on the cards. Net profit growth, optical net profit growth would be about 36%. Remember, because in the base quarter, we had a P&L adjustment item of close to around 40 crores. So if you add that, the net profit growth on a relative basis would look much lower. Absolute numbers we're looking at around 440 to 450 crores on the bottom line. The biggest component of their revenue, ad revenue, we're working with a level of anywhere between 15 to 17% reported ad revenue growth and subscription growth of 16 to 18%. Most importantly, management commentary on investments in Z5 and the update with regards to the stake sale will be watched out for.
Okay, thanks a lot for that.